All right, let's talk about something that hits every single one of us right in the wallet: taxes. But we're not just talking about paying them. We're on a mission today to find those hidden, often missed tax credits that could literally put hundreds, maybe even thousands, of dollars right back where they belong, in your pocket. So let's jump right in.
So just to give you a sense of how big of a deal this is, get this. The IRS itself says that almost 1 out of every 5 taxpayers, that's 20%, who are eligible for the Earned Income Tax Credit just don't claim it. And listen, that's just one credit. It just goes to show you there's this huge gap where real money is being left behind, all because people either don't know about these savings or, the rules just seem too complicated.
And that really brings us to the big question, right? Are you leaving money on the table for the IRS? By the time we're done here, my goal is to give you the strategic insights you need to look at your tax situation and confidently say, nope, not me.
Okay, so to really get our arms around this, we're going to break it down logically. We'll start with savings at home, then look at family-related savings, and then savings for your future. Once we've got those buckets covered, we're going to zoom out and talk strategy, specifically the critical difference between credits and deductions. And finally, we'll tie it all together to look at what this means for your financial bottom line.
All right, first up, savings at home. We're talking about your biggest asset, right? And believe it or not, there are some pretty significant savings hiding in residential energy credits, especially thanks to some recent changes in the law.
So there are really 2 key credits you need to have on your radar here, and both got a nice boost back in 2022. The main things to remember are these are for your primary residence only, not a rental or vacation home, and you have to claim the credit in the same year you actually did the work. So work done last year goes on last year's tax return. Simple as that.
Now let's break these down, because this is where it gets really interesting. On one hand, you've got the energy-efficient home improvement credit. This is for things like new windows, doors, insulation, the stuff that makes your home cozier. It's great, you get 30% of what you spend back, but it's capped at $1,200 a year. But then, look at the other one, the residential clean energy credit. This is for the big-ticket items. We're talking solar panels, geothermal, that kind of thing. And here's the game changer. It's also a 30% credit, but, and this is huge, there is no cap. No annual limit, no lifetime limit. That can translate into absolutely massive savings.
Okay, and I need you to pay close attention to this next part because it is urgent. As the law stands right now, these powerful credits are set to disappear on December 31st, 2025. That's it, gone. So the clock is ticking. If you've been on the fence about any of these home projects, you've got a window of opportunity here, but it is closing. You definitely want to factor this deadline into your planning.
Okay, let's pivot to our next area, savings for your family. We're moving from the house itself to the people inside it. And this is an area where a lot of people think they know all the rules, but some really common and really costly misunderstandings are floating around.
Here's a perfect example of what I'm talking about. When you hear Child Independent Care Credit, what do you think of? Daycare for little kids, right? Well, that's what most people think, but its scope is actually way, way broader. You can claim this for the cost of care for any dependent who can't care for themselves. We're talking about an elderly parent or even a spouse. For anyone out there in that sandwich generation, juggling kids and aging parents, this is an absolute game changer.
So how much is it worth? Well, it depends on your income, specifically your adjusted gross income, or AGI. If you're on the lower end of the income scale, you can get back up to 35% of what you spent on care. Now, as your income goes up, that percentage slides down to 20%. But hey, even getting 20% of those costs knocked directly off your tax bill, that is a huge help.
Now, there's another credit that often gets overlooked. It's kind of like the lesser-known cousin of the big child tax credit. It's called the Credit for Other Dependents, and it's a straight-up, flat $500 credit. It's designed specifically for those situations where you're supporting someone who doesn't quite fit the mold for the child tax credit.
So who exactly are we talking about here? The IRS uses the term qualifying relative, and this is where the tax code can be surprisingly, flexible. This could be your kid who's over 17 and in college. It could be an elderly parent you're helping to support. It could even be a friend or other non-relative who lives with you full-time and depends on you. The key here, and what makes it so different from the child tax credit, is that there is no age limit.
Look, I get it. The rules can feel a little murky. But the good news is you don't have to guess. The IRS actually has a super handy tool on their website that walks you through it. Seriously, it takes maybe 10 minutes. You just go to irs.gov, find the tool, plug in your dependent's info, answer a few questions, and boom, it tells you whether you're eligible. It's all about taking control and getting a clear answer for yourself.
Okay, let's move on to our third bucket of savings. We've covered your home, we've covered your family, now it's time to talk about your future. And yes, there is a tax credit specifically designed to give you a bonus for saving for retirement.
It's officially called the Retirement Savings Contribution Credit, but pretty much everyone just calls it the Savers Credit. And the idea behind it is simple. The IRS is basically willing to give you a little reward, a little bonus, for doing the right thing and saving for retirement. It's a direct thank you in the form of a tax credit for putting money into your retirement accounts.
And here's how it works. It's pretty cool. The credit is basically a percentage of what you contribute. If your income is below a certain level, the government will give you a credit worth 50% of your contribution, up to a certain amount. Think about that. It's like getting a 50-cent match from the IRS for every dollar you save. As your income rises, that percentage drops to 20%, then 10%. But even a 10% match that comes right off your tax bill, that's an amazing return on your savings.
And the best part? The eligibility is super straightforward. Just run through this quick checklist in your head. Are you at least 18? Check. Are you not being claimed as a dependent on someone else's return? Check. Are you not a full-time student? Check. And did you put money into a 401k, an IRA, or another retirement plan? If you can say yes to all four, then you absolutely need to see if your income qualifies you for this credit.
Okay, so we've just gone through a bunch of specific tactical ways you can save. Now, let's pull back and look at the bigger picture, the strategy. Because if you really want to be in control of your tax situation, you have to understand the huge fundamental difference between a tax credit and a tax deduction. They sound similar, but trust me, they are not the same thing at all.
And here is the critical difference. A tax credit is pure gold. It's a dollar-for-dollar reduction of your final tax bill. So a $1,000 credit saves you exactly $1,000. Simple. A deduction, though, it just lowers the amount of your income that gets taxed. So a $1,000 deduction, if you're in the 22% tax bracket, only saves you $220. The analogy here is perfect. A credit is like a gift card. You hand it over at the end, and it takes that exact amount off your total bill. A deduction is more like a coupon. It lowers the price a little bit before they calculate the tax. All things being equal, you want the credit. It's almost always way more valuable.
So this all brings us to the real bottom line here. It's about taking control. All these tactics, all this strategy, it's all about shifting your mindset. Your tax bill isn't just some number that happens to you every year. It's something you can influence, something you can manage.
And you really have to stay on your toes, because this stuff is always changing. The tax landscape is dynamic. Inflation adjusts all the numbers and income levels every single year. Congress passes new laws that can create amazing new credits, or make old ones disappear. And of course, your life changes. You buy a house, you have a kid, you get a raise. All of these things can subtly make you eligible for savings you didn't qualify for last year.
Which really leaves us with one final, powerful question. This is about more than just finding a few extra bucks. It's about a fundamental shift in how you see your finances. It's about stepping up and acting like the CEO of your own financial life, being proactive, looking for opportunities, and making those smart strategic calls. So the real question is, are you ready to be your own CEO?